Hello, good afternoon. Welcome to this special Legal Futures webinar in association with the Solicitors Regulation Authority on whether solicitors should continue to hold client money. I'm Neil Rose, I'm the editor of Legal Futures. Today's webinar comes off the back of the SRA starting a conversation about the future of client protection arrangements in the wake of Eaton-Evans in particular, and more generally, an increase in the number and size of interventions this is carrying out. This all carries a significant cost to the profession. The Consumer Protection Review essentially aims to answer whether there is more the regulator can do to identify firms that might fail and how to protect consumers when they do. It began in February with publication of a paper setting out the scope of the review, and today's webinar is one small part of the SRA's engagement with the profession on it. I'm going to put a link to the discussion paper in the chat shortly. The closing date for comments is the 1st of July, and I'd encourage you all to have your say. The kinds of changes that could result from the review range from incremental improvements in the SRA's processes to radical reform of the regulatory framework. I very much like stuff at the radical end. That's the really interesting stuff, and it's that end that we are looking at today. The question, put simply, is whether the benefits of holding client money outweigh the considerable risks and also costs. Imagine life without the burdensome accounts rules. So we've put together a diverse panel to discuss these issues. If I can ask them to put their cameras on and unmute themselves. We have SRA Chief Executive Paul Phillip, Sarah Charlton, the Chief Executive of Eaton-Evans and Morris, a high street law firm in Mid Wales. And Sarah personally has a long history in law firm management and accounts. Marc Jones, Risk and Compliance Director at Travers Smith, which as a large city law firm often has very large amounts of client money to contend with. Claire Stewart, Managing Director of Bridge Law, a welcome late addition to the panel. Bridge Law is a full-service firm with offices in Cheshire and Yorkshire that doesn't have a client account and instead uses a third-party managed account. And Janet Taylor, joint owner of Taylor Mowbray, an accountant who specialises in the accounts rules, as if being an accountant isn't exciting enough. Paul is going to set the scene for us, and I'll then chair a discussion with the panel. Please use the Q&A box to submit questions, not the chat box. A link to the recording will be sent to everyone who registered later today. We have over 450 people registered, some are going to be watching later. If I can ask, I think it's time to get going on everything. So, Paul, please take it away.
Thank you, Neil. As always, Neil and I never shared scripts, so he's covered quite a lot of my introduction. But yeah, as Neil said, we have now been engaged in the foothills of a quite wide-ranging client protection review in the aftermath of the collapse of Eaton-Evans last year. But it was not just Eaton-Evans, as Neil alluded to. Our interventions into law firms has gone up by about 250% in the last couple of years. And we do have to ask ourselves whether the cost of providing compensation arrangements for clients is both affordable and proportionate for the profession. I thought the title of Neil's blog advertising this session was quite witty, halving the size of the SRA. And whilst I understand the sentiment, I don't think that's going to happen anytime soon. But it is true to say that a lot of costs of the practicing certificate fee and all of the costs of the comp fund fee, the compensation fund fee, flow from firms holding client money. So the cost of regulation would drop very significantly if firms didn't hold client money. And I wish I could say that there's not a lot of traffic about in terms of us dealing with inappropriate handling or misappropriation of client funds, but I'm sorry to say that there is. Or in the case of anti-money laundering, failure to implement the appropriate regime around risk management, client due diligence or source of wealth checks, all facilitating or certainly increasing the risk of facilitating money laundering, which of course flows directly from having a client account. So we're in the foothills of our work. We will look at a number of, as Neil says, relatively smaller issues rather than more radical ideas. How to spot the next big thing in terms of risk identification, operational issues such as the role of the COP and the COFA, and the independent accountants and their reports and their qualifications and how often we see those. And things such as other checks and balances over control of the client accounts and tightening up on, as Neil says, the dreaded accounts rules. But also things like, should there be stricter rules on residual balances, and whether these should be repatriated sooner, or whether we can't, where they can't, rather, that the balance is actually put in a safe place rather than just held with the firm. But we have to talk about client money, so we'll also be looking at issues as to whether or not firms should be allowed to hold client money, given every chain is only as good as its weakest link. As I've already said, there are unfortunately many, many weak links in the solicitors profession. So the reality is it's not about what's happening in your firm, where I'm sure things are very, very tidy, but whether or not there are too many firms that are flaunting the rules and misappropriating or just mismanagement of client accounts. Can you imagine a world where solicitors didn't and couldn't hold client funds? It happens in other jurisdictions. It happens in France. It happens in some states in America. People say the market is not mature enough, that it is part of the identity of a solicitor to hold client funds, that it's convenient and that clients expect it. But if you couldn't hold client funds, the cost of regulation would drop like a stone. AML issues was dissolved overnight. The risk of failing trust in the profession of mishandling client funds would simply just go away. And that's not to mention the cost of PII, no doubt going down radically. I'm not here to say that it could happen overnight. The market does need to develop and the transaction costs need to be far more proportionate. But I've no doubt that over the medium term, we could deliver a more mature market in third-party managed accounts. As they say in the movies, build it and they will come. I think if we were to change the rules to stop firms holding client money, other arrangements would develop very, very quickly, that the market would mature and the costs would go down. So really, that's by way of introduction. I think where we will be getting to in our further consultation later in the years, later this year rather, when we explore the whole idea of holding client money, as well as a number of the other issues that I've raised this afternoon. Thanks, Neil.
Thank you, Paul. That's a good scene setter. I'll start with Sarah then. If you can talk about your, oh, there we go. We've got the result of the poll. Not as clear cut as perhaps I thought it would be, and there is, I think the 30% not sure perhaps reflects that there really are questions now, perhaps there weren't 10, 20 years ago about holding client money. So, Sarah, if you can give us your perspective of as a chief executive of a traditional high street firm.
Thank you very much, Neil, and thank you for inviting me alongside all of the other panel guests today. I think that it's probably good to sort of set the scene. Whilst we are very much traditional in our values, our approach is very tech focused. So we do use policies and processes. We use tech to be able to apply policies and processes to try and stop people from coming off the path that we want them to go onto in dealing with client money. I'd also say the key for us is exceptionally trained accounts team, not one person, it is a team, and they're all trained to a very, very high level. So we don't rely on one person. If one person is away, it doesn't all fall down, whether that's myself or whether that's the accounts manager. Anyone working within the accounts department does get trained to a particular standard. We select people who are not just going to do something because a partner has asked them. We select people who will have a voice, and somebody that, if they were concerned, that they would just decline the request, or they would refer it or escalate it to either another partner. There's only two directors in the law firm, but they'll escalate it to another director just to get verification that that's appropriate. We are a general law firm, so we do a lot of probate work. We obviously do a lot of property work. So from a risk profile and a professional indemnity insurance as well as practice and certificate, we probably do sit there, maybe paying the higher premiums because of the type of work that we do. But I definitely feel that having an accounts team rather than one individual that's able to have a voice and is respected within the entire business, including the directors, where if she turns around and says, no, I'm not happy with this, I need to do some research, or I need to ring up the SRA ethics helpline, she would do that before she would actually complete a transaction. I'd also say we have very much a culture of openness and transparency. So when somebody makes a mistake, it is a team problem. It's not their individual problem. So there isn't a case of concealment. There isn't a case of people feeling that they're going to be finger pointed or persecution. When mistakes happen, and they do, because we're not robots, this isn't AI, there are human elements to it. And whilst we use tech and we try to automate whatever we can, you are as strong as your weakest link at the end of the day. So we do try to reflect on if something's gone wrong. So if money's gone to the wrong person, or maybe the ID checks or the source of funds checks haven't been done before the funds have been released, and we've discovered that via an audit, we do look to make those continuous improvements. And like I said, our approach is very much, how can we change? How can we make things better, rather than you did this and you did that? So I think they're elements and ingredients that we have. I think that as a firm and as an entire team, there are 3 goals that we try to do every single day. And I know it sounds cheesy and it probably sounds like an American law firm, even though we're in the depths of Southwest Wales. But it's about protecting client money, it's client experience, and it's the quality of legal advice. They're the 3 things that we try every single day to make sure that we do exceptionally well. There's other stuff, obviously, that sits around that and supports that, but that's a team effort. That's not one person swimming that way and you've got 19 people swimming the other way, so you've got no chance of being able to get there. And then I think when we look to put compliance mechanisms in to protect client money, because obviously there is a huge amount of risk, and when you're negotiating your professional indemnity insurance, it's a key part of that is demonstrating the appetite of risk that you have, and also not just saying it in words, but being able to give evidence of saying this is how we managed to stop this from happening. It's about proportion. In a small law firm, we don't have deep pockets, so we'd echo the stuff that the SRA are doing around trying to consider a better way of protecting the indemnity fund, because we don't have the money, we don't have the margins, we don't have the working capital to just be paying ad hoc sums to supplement the Axiom Inc. situations and so forth. But anything that we put in place there is a level of proportion to it. So we wouldn't just put something in place for the sake of it, for it happening once in a blue moon. We would be very much engaging with the fee earners to work out the best way that we can implement something with the greatest success. It's not a case of me sitting in my ivory tower just deciding that I'm actually going to get them to tick an extra box and then I'm just going to sleep at night. It doesn't work like that. I need to know that if I'm going to put something in place, that I have the fee earners buy-in and it's actually going to work. So they don't do a lot. A lot of our compliance is integrated in every day. So it's not something they consciously think about. And I think those are all the ingredients that bring our risk on client money to a manageable level.
Okay, thank you, Sarah. We'll come back to some of the other issues and the issues you raise, but I want to go from small to large and go to Marc for a very different perspective. Of course, he's not in an ivory tower, even though he's in the city. Although maybe your desk's made of ivory. Marc, your perspective.
Thank you, Neil, from my very wooden desk, not an ivory one. Thank you for including me in today's discussion. Yeah, I mean, the Travers journey, and it really has been a journey since I joined the firm 10 years ago, has been to gradually move away, almost taper, I suppose, off utilizing the firm's client account wherever we feel we reasonably can do that. And that's largely in consequence of our recognition of the risk, really. And some of those risks we've come face to face with over the years. It's the scenario where completion on a deal or a transaction is approaching and you get a cyber criminal pop up trying to intercept funds in what are becoming increasingly more and more sophisticated ways nowadays. We've always managed to avoid falling prey to those attempts, but at some point, how sophisticated will they become? But then, of course, the more you do something, the more risk, the more scope there is for other things to go wrong. And I know we're all very conscious of the famous rule 3.3, which is a really important rule. And to be clear on that rule, it precludes us, of course, as lawyers from utilizing the client account as banking facilities. And if your firm is anything like ours, you will encounter requests from clients from time to time to do things with the client account that you are not sure necessarily fall on the right side of that rule. And I'm not sure, if you're anything like me, you won't be overly enthusiastic about locking horns with that particular rule. I should say that we did not launch into a policy position on utilizing the client account overnight. As I said, it's been a very gradual process, largely because we've wanted to be sure that along the way, viable alternatives for our clients, alternatives that make sense. And in our case, that has been through the use of third-party payment agents. I should probably call them escrow agents. I don't want to confuse things with TPMAs, which are, of course, very different, more or less outsourced client account arrangements, whereas what we're doing is more transactional specific, right? An escrow agent is used per deal. That has been our solution in the circumstances where we felt, the client account is something we don't want to risk using. So that's not to say we don't use it at all. On the contrary, it remains very much normal practice for our real estate work. But if you look at our sort of daily average balances and average amounts received over a year and paid out over a year now, today versus what they were 5 or 6 years ago, the figures are fractional by comparison, and that for me is a reassuring story from a risk management perspective. Anyway, we do now have a policy. But I would say to you, if you're going to go down the route of having a policy, make sure it's one that you can comply with, and one has to be careful of hostages to fortune here. And our policy is ultimately to restrict use of the client account to those circumstances where we feel, as I said earlier, there's no viable alternative for the client. One cannot forget the duty we all have to act in the best interests of our clients. And indeed, we will not use the client account where the money involved transgresses a prescribed threshold, which is set out in the policy. Anything over that threshold has to be agreed by our managing partner, senior partner, or chief financial officer. So it's 2 of those 3 people who have to sign it off. And there's a blanket sort of presumption that we will never, for obvious reasons, hold money over the firm's PII limit. So anything over those thresholds must be managed by we'll call them escrow agents now. And we have a few, as you'd expect, who we've worked with over the years, who we consider trustworthy and reliable. Clearly, one cannot leave discussions around these arrangements to the last minute. There's nothing more frustrating than, completion date approaching, and people start to think at the last minute about what we're going to do about the money, the funds flow. Because what I find incredibly frustrating, and this may be something others of you have encountered, is when one firm has one policy and another firm has a totally different policy. In our case, we find ourselves sort of having to hold the baby at the end of the day, and use our client accounts in circumstances where we might ordinarily have preferred not to. So thinking about this at the earliest possible stages, I would say at engagement stage, even set out in your engagement letter, once you've agreed with your client what you can do with the management of funds, set it all out in the engagement letter and do it that way. And of course, where you do elect to use the client accounts, or where we do, all efforts are made to mitigate risk to the full extent we can. And that's done a number of ways. We clearly go to huge lengths to verify account details. Sarah spoke about her reliable accounts team, which is critically important in that context. You need people who are thorough. All of that, those expected steps, are in our policy, and people have to do that first. We may on occasion even transfer a small sum of money first, £1, £5, whatever, make sure it clears safely. But then when we're comfortable, we go ahead and fire the full amount over. Liability caps are another thing you want to make sure you have in place, but I do think there is a slightly false sense of security with liability caps. You do what you like contractually with your clients, but don't forget Rule 6 of the accounts rules, which provides that any money improperly withheld or withdrawn from the client account must be immediately paid into the account or replaced as appropriate. We have this obligation to replenish the client account where money is misappropriated. Another one of those rules I am unenthusiastic about running into. So yeah, I think that's largely our story, Neil. I don't want to go on too much longer, but if there are any questions arising, happy to answer.
Okay. Well, we'll come back. Well, let's move on to Claire, if you can unmute yourself, about your experience of not having a client account.
So we don't have a client account. We use third-party managed accounts. We don't have an accounts team at all. And the way it works is that the fee earner with responsibility for the file opens an account on the TPMA platform. And that fee earner who knows the case manages with the accounts team at the third-party managed account what information is required to be uploaded, be that source of funds, ID, and that fee earner directs where the client funds are going to go and how they're managed. If the fee earner is away, they are supported, but generally the platform is accessible from anywhere with the right codes. It's safe and secure, and it keeps costs down as the staff themselves are running the account. There's no need for a separate person doing that, and the checks are carried out by the third-party managed account provider. So for us, it has worked very well. We do probate work. We do a lot of litigation on obtain monies on account. It's not completely over expensive, and I think it's a really good option, certainly for our firm, which is a small firm.
So I think we can say it's Shield Pay you use. It wouldn't be a huge surprise because I'm not sure there's anyone else really offering it. And why did you go down this road?
As a law firm, we're regulated by the Bar Standards Board, and so it is prohibited to hold client money. But also as a Colpin Coffer, I feel better that these extra checks are in place and that there isn't somebody or an accounts team with control of the client account. For me, I feel more comfortable running it in this way, and I've been very happy with the way it works.
And cost of it, it's often, people often complain that they're put off by the costs of TPMA. Is that, I mean, presumably it's also reflected in lower insurance premiums, although with a BSB firm you'll be a slightly different situation anyway.
Yes, the insurance premium is really low, but the cost is quite low per month. I mean, we are a small firm, but the account, if a property is sold, then there's still quite a lot of money being held in the Shield Pay. It's never any more than £500 a month.
Right. Okay.
So the cost benefit works out really with the fee earners managing their own respective accounts on the platform.
And it doesn't put much burden on the fee earners.
No, not at all, because presumably the fee earners, if they wanted to move client money, would have to tell the accounts team anyway.
And do you have any final question for you without making this just a Q&A with you? Do you have any oversight role in terms of what's happening with the client money?
There is an oversight role, but I'm not required to authorise every transaction. Shield Pay are comfortable and on board the fee earners. If there's any issue, I'm always phoned, and therefore it's comfortable that all the checks and balances have been carried out.
Okay, well, I'm sure we've got more questions for you, and we've got some questions coming in. Remind people to put them in the Q&A rather than the chat if they can. Janet, you've got that. We've asked you on because you've got the broader experience of working with law firms and seeing how they work with the accounts rules. What's your perspective?
suppose the first thing, I guess it's not for my profession to tell your profession, everybody listen, what they ought to do. But, you know, as slightly, well, not quite an innocent bystander, though, I suppose, in all of this. I suppose it'd be easy to assume that as a reporting accountant, I've just got a vested interest in client money remaining where it is because it's a source of funds and so on. But I don't believe that is my profession's view at all. We've had to adapt to things, obviously, in the past, when audit exemption came in over 20 years ago. You've got to think about, okay, what else do you do? And actually, I know a lot of reporting accountants that do this work alongside all the other work that they do for their law firm clients who, you know, wouldn't be so sorry not to have to pick up this aspect of it. But that perhaps being slightly glib there. But I think the key thing, obviously, is going to be what is best for the clients, what is best for the profession in the 21st century. I know that it's been alluded to, and Paul alluded to sort of other jurisdictions, and I know France, as I say, for many years has different, but it's not exactly renowned, is it, globally for being the most efficient, smooth way of dealing with all of this. So I think people would obviously want to make a lot of comparisons there. I think what I would say, and then maybe I'll just make 3 quick points on this, is that as Paul alluded to, even if ultimately the decision is that firms will not hold client money, it's clearly going to be quite a long process and a gradual process. I would certainly say that even in that interim, that the role of the reporting accountant, the filing of reports, and who does what is something that needs careful review, even for that interim period. But obviously that's a point for another day. It's not really entirely pertinent to what we're looking at. But I think the 3 points that I would make, and they kind of pick up on things that people have done already, and picking up on, you know, particularly what Sarah was saying at the outset, you know, there's never no risk, but I see many, and I would have to say the vast majority of law firms who have efficient, effective, productive accounts teams that have a strong, you know, governance culture within them, where this works very well. And dare I say, often those who, alongside the tech and all the modern stuff, have a mindset that's maybe a little bit more akin to the prescriptive rules that we used to have, and that, you know, that's, I mean, you know, maybe that's unfair, but I sometimes wonder if the rule shift was too much too soon in some respects for a number of firms. And many firms, and many of those firms will very keenly believe and be able to demonstrate, and I'm sure Sarah can certainly, that their clients, that they have got clients who prefer it. A lot of my law firm clients will tell me that, especially long-standing clients, you know, is part of the trust that they have in the firm. And maybe there's a generational issue with some of these things. Maybe it's different, going to be different moving forward, but you don't want people getting left behind. And I think that potentially a shift away, whether wholeheartedly or in chunks, could send out a message that undermines that trust. And some firms may feel that undermines that trust. You know, your own regulator doesn't allow it. Oh, and the other thing I was thinking of in the context of that was, you know, the link into things like clients' own accounts. I mean, they're a very high risk area. We know that, but you know, perception is very important in these things, isn't it? And again, what I see in terms of my law firm clients and their clients, you know, the perception of those clients may well be, well, okay, so the regulator is saying it's too high risk and we don't want you to hold the money relating to a sophisticated corporate client, but you can operate a client's own account, for example, for somebody who's vulnerable. You know, how do you square those circles? So I think there's a lot of things obviously around that. I'm asking questions rather than proposing answers and solutions, obviously, but what I sort of things, and that's where I see certainly quite a lot of risk, and obviously perception is very important. People have talked about the costs and the benefits. Obviously, that's a key thing, and either as a reporting accountant or, you know, somebody looking at the finances of a law firm. Obviously, you've got finance teams, you've got the software, you've got the insurance, you've got the training, all those sorts of things. If you're going to take one financial benefit, obviously there's interest, and people in law firms may be able to look at all of those to a certain extent. But and obviously, Claire's perspective is really important in terms of the cost to them and the benefit alongside that. But a lot of those finance functions will still remain anyway in many law firms. You know, the raising of bills. I mean, the rules do require, even if you have TPMAs, you've got to keep a record and reconcile things and understand. And ultimately, there is that responsibility for the financial management of that client's matter, and that's dealt with appropriately. So how many of those costs would really go in that shift? And TPMAs, if that was the route, they're not charities. So I think there's quite a lot of people would want quite a lot of data and information to be convinced around that. And obviously nothing that would increase the cost of legal services. So I'm not saying it does. I'm just saying that there's certainly perceptions out there and whether there's sufficient data around a lot of it. And I suppose the final thing I would mention, and it was one that Marc mentioned as well, if I'm going to look at it very much from the other side, there is a big bit of me, given that probably rule 3.3 is the question I get asked most often, and exactly in the way that Marc alluded to. Nobody's thought ahead. Completion is tomorrow. They haven't got a bank account. Janet, what can I do? And I think there's no magic wand I can wave. Why haven't you thought about this? If there was something that removed that from my arena, I wouldn't be entirely sorry. But also alongside that, the residual balance problem, because they are two of the biggest issues and the biggest problems in firms with the residual balances. So I'm not a believer in just shift the regulation responsibility to somebody else, but there is an aspect of that. I think residual balances, it certainly needs some further consideration and thought, because it may well deal with them going forward, but an awful lot of the issues here, historic ones, which this shift won't deal with entirely. But I suppose they're the main things I would sort of see and think and noises off about in my role as reporting accountant, if that helps.
That's great, Jan. That's really good. I mean, there was one firm recently that they had residual balances going back like almost 30 years.
Yeah.
It was extraordinary.
They're naming lights on my slides at the moment.
And it's not just a problem for the SRA. I know that other regulators have talked about it as well. And Rule 3.3 came out of the SRA's recent year 3 evaluation of the standards and regulations as one of the rules that causes the most problems. So I'm sure that is very much on your radar, Paul. Well, actually, I'll ask you that: is Rule 3.3 under particular scrutiny?
I think anything to do with residual balances is definitely under.
Yeah, but more 3.3 about banking facility.
Yeah, of course. Yeah, because you should always be an underlying legal transaction before you have any money in your account. So
but it is clearly causing people problems.
Yeah, it's definitely under scrutiny. Interestingly, on the residual balances, I've seen the other week that the MOJ are presently looking at that and whether or not those balances should be repatriated for more public good. That's all I know about it. That was on the press statement from the MOJ.
I'm going to go to Sarah on that idea of, I know you're probably the wrong person to ask this as a former chair of the Institute of Legal Finance and Management, but the idea of not having an accounts team, does that not appeal to you?
I'm not bothered either way. I'm not precious over it. I don't feel an affiliation of client money that it has to come into the law firm, but I think any alternative solution has to be robust and practical. I think you've got a mixture of clients. Some clients will trust their solicitor and like to be able to come in with a checkbook because, you know, our client base, we still have a very mixed bag of tech people that just want to pay it online at the same time as elderly people, farmers and things like that who want to come in with their checkbook and see somebody and hand their physical check over. So we do definitely have a mixed bag, but I think the profession as a whole, yes, you can have some people who are going to have a sentimental association with client account, but as long as the firm can practice effectively and efficiently, and as long as the legal transaction can be delivered in the best possible way for the client, I don't care where the money is or what's happening.
I mean, and do clients care? I mean, is this a cultural, historic hangover, or is?
I think that it was something that Marc touched on, actually. I think that clients are more astute around cybercrime, and I think they're more nervous about sending money. So I don't think it's about it where it's held. I think it's actually about the transfer itself. And I know with escrow accounts and TPMA accounts, there has been nervousness around how many bank accounts that might travel through on occasions. I feel like the risk sits around the transferring from a client's perspective, because they wouldn't read the legal future, so they wouldn't necessarily know that there's residue balance issues and there's all of these other issues. They would be immune to that. All they'd be concerned about is cybercrime is a big play, and there's a lot of money that they send law firms. There's big figure sums, and then mortgage advance comes into us. So I think from a client's perspective, it's all more about the world and how the movement of money. And that's why I think TPMS perhaps won't take off. And I know that Claire, it's obviously it's worked well for Claire, but Claire is Bar Standards Board, so perhaps if you had a choice, or you previously had the luxury of a client account and the choice was there, maybe, you know, a TPMA might not have been necessarily your option. May still have been, but
well, I'll come back to you, Claire, in a moment. But I want to ask Marc, you've got sophisticated clients. Presumably, they don't really care how the money gets transferred as long as it gets transferred safely. Doesn't have. They're not fixated on it going through the security of a solicitor's client account.
Yeah, I think that's right. Look, I do think there is a sense of you know, the solicitor's client account being a safe pair of hands, and it's increasingly attractive to be able to offer your clients a one-stop shop for all their needs, and not have to do one thing here and another thing there. That probably introduces an element of frustration, but by and large, yeah, I think you're right. The sophisticated user of legal services is more focused on just getting it right, really, and so we haven't encountered a lot of difficulty in that respect, I must say.
How about other law firms, though? How do they react to less traditional ways of moving client money?
Yeah, I mean, that's you know, as I touched on earlier, that's where we find it a little bit trickier. You know, one law firm has one policy and another has another policy. But by and large, as long as there is you know, consensus from the earliest possible stages as to how the money is going to be managed, and everyone's comfortable with it in a safe place, with a reputable provider. Again, I don't recall this, and I'm not sure I'm the perfect person to speak to this. I'm not, you know, a corporate lawyer, but I'm not aware of issues having been raised there either.
We've had quite a lot of questions in. Claire started answering them in the Q&A box, but I asked her to because not everyone's looking at that, to instead stop doing that. So sorry, Claire, this has become a bit of a interrogation.
That's okay.
That is so. Yeah, so there was a question about whether you've had any issues releasing funds from financial institutions where your firm isn't named on the grant of probate. So you say that's not been a problem so far?
So far not. If there are any questions asked, they're quite quickly dispensed with. So far, in my experience.
Who's responsible for paying for the TPMA? Who pays the fees?
So it's a contract between this firm and the TPMA provider. So we pay the TPMA provider, and we do have in a client care letter, like you would with bank transactions through the client account. If there's a SWIFT fee or a BACS fee, it's a similar amount. Off the top of my head, it's £25.
Right. Okay. There's a question about what if a fee owner was misappropriating client funds? How could Shield Pay pick that up, or would they pick that up?
I don't think it would be possible for a fee earner to misappropriate client funds, because you have to complete a Excel spreadsheet which is uploaded to the platform, which details the bank account. If it's a settlement agreement, the settlement agreement, every single part of the sort code, the name of the person, it's all thoroughly checked.
Okay.
So I just don't see how that could happen. I should point out, though, that we don't do conveyancing. So
well, yes, there was a question. There was a question whether this could work for a conveyancing practice. but that's maybe not one for you to answer. There's a question maybe for you, Paul, on whether, I mean, I thought this when you said that about AML issues, they wouldn't, just
They
because you're
wouldn't go
not
away
touching the money, they wouldn't,
completely.
because
No.
you would still have to check source of funds, source of wealth, etc., wouldn't you?
You would, but you wouldn't be facilitating money laundering by having the money yourself. But yes, you would still need to do quite a lot of stuff. But my point is that an enormous amount of bureaucracy and rules and regulations and cost, and actually I'm glad that Marc picked up on the cybercrime issue, would actually go away overnight, and actually your PII premium should really go down. I was really interested in I think it was Janet's point, saying that actually, well, it's because Claire's a BSB firm, she has no other choice, and therefore she does it. But if Solicitor had no other choice, would Claire is just a demonstration of the fact that it can work. So if there was no other choice for firms, I honestly believe the market would develop really quickly, and the transaction costs wouldn't be anywhere near as high as they are at the moment.
So I guess this is this is a question for Martin McGinley. Again, I mean, Claire, you're not here as a spokesperson for Shield Pen, and I mean, if you how secure, the question I suppose is how secure are third-party providers, but they're probably more secure than solicitors firms, dare one say.
Yeah, I mean, they're regulated by the Financial Conduct Authority, which is, their regulation is quite strict. I've not had any issue at all. And in terms of the residuary balances issue, we are circulated a list of what's in the account every so often, and it's dealt with. So
yeah, I mean, are there like time limits on how long you can have the account after a transaction's completed?
not that I'm aware,
that would
but
be quite a good way of forcing people's hands, perhaps.
but we don't have, those residuary balances are either sent back to the client or wherever they should go. But that's managed quite well. I've not had any problem with clients objecting to the third-party managed account being used.
Well, yes, it did. So what do you tell clients?
So we say we operate a third-party managed account, and there is
they wouldn't, which presumably nobody understands.
There's a little booklet which you send out, but we can explain it to them that the money is held on our behalf by a third party, and it's actually transparent for the client because they have access to the platform as well. They're invited to the platform and they can see the funds.
Oh, right, okay.
So they have transparency on that.
So this, the question raised by Jason Mitchell, which I was going to ask about client account interest. I mean, maybe Janet, you could start with this. I mean, I've come across firms that, well, I've been told it was, in the past at least, it was their main source of income. Things we had a few years where it wasn't so good, but thanks to Liz Truss, things have improved significantly on that front. There was the Law Society survey a few months ago showing there was a 1,000% increase in the amount of client interest received by the 150 odd firms they surveyed, all small firms. It's got to be part, even though it shouldn't be part of the discussion because law firms shouldn't be relying on it. It is part of the discussion, isn't it, Janet?
Well, it certainly is part of the discussion. I mean, I remember many years ago, the rude thing you could say to a law firm, and I think of some of the conveyancing firms I might have dealt with 30 odd plus years ago, you look at their profit and you'd say, you're not really a law firm. I mean, all the profits you've made from interest, all you've just made money from. But that said, we've come a long way in terms of commerciality and business and so on around all of that. And I think probably it's a bit simplistic to sort of say, well, they only want to hold the money to earn the interest and so on. But yes, it is obviously a or can be an important aspect. I think as well that although those figures look, percentage increases X, it was from a very, very low base in terms of where interest rates have been and so on. And certainly, when I look back to my early years of doing this, it's not the same proportion anyway of profits that it used to be. But yeah, I understand that. Some firms will say, well, it sort of contributes towards the cost of, and then Paul will say, well, if you didn't have the cost, you don't need the contribution towards the cost in relation to this. So I don't know what the answer is in terms of that. I know I think that it will be a consideration for firms. I think that I would worry about any firm who relied in terms of its business model in that interest too heavily. But I do think it is a contributor in terms of the costs attached to all of this. But I think that I know, talking to the TPMA provider we've mentioned a few times this morning, last week, that there's no prohibition on them sharing. They're looking into that and so on. So it can be part of the discussion in terms of the using of the TPMA provider in respect of all of that. So it is one that worries law firms as well, in terms of whether they're doing the right thing in terms of what they're paying over to the clients as well as what they're holding on to. But I don't think it's I think it's something that would have to be considered reasonably carefully and well. The perception around it would need to be well managed.
I mean, Paul, you were shaking your head at the notion of law firms making lots of money from client
From other people's money.
Yeah.
Yeah, I mean, that's the point, isn't it? The money belongs to the client, and actually you've got to ask yourself whether or not it's really appropriate to making lots of inverted commas profit from other people's money. So that was why I'm shaking my head. And
it is significant, I think, that we reported a couple of weeks ago that as you said, the Ministry of Justice is now looking at this and it's something that you see in other Commonwealth or common law countries, certainly client account interest. Well, actually, not just common law, France as well, where interest is actually applied to pro bono support, or essentially, I guess, to supplement legal aid, which is a completely different argument. But it's not lawyers' money, so it should go to other causes. That kind of pooled interest.
I suppose, sorry, just as one last point in that, again, and I'm not saying rightly or wrongly on this, there is obviously, the potential, and obviously one of the key things from the SRA's perspective is to make sure that, the cost of legal services is accessible and so on. And there has to be perhaps some consideration of the impact that could be of that, rightly or wrongly, when, interest disappears from the mix, just as I'll throw that in. The
question's really flooding in, which is great. The question here about whether accountants would have a competitive advantage. Ones, they can provide some legal services as well. But if they could hold client money and solicitors couldn't, I'm not sure. But it's a question of how much, I guess, the solicitor's reputation is based on holding client money. I mean, does anyone think it is that integral now to a solicitor's reputation?
I don't think it is, but I would just want to pick up on the interest side of things. I think that sometimes it can be an indicator of culture in the firm on how robust and how fair their policies are. I would say that more often than not in my consultancy work I see very poor policies where the de minimis figure is way too high, or they've opted a client out and they haven't done it on an individual basis. They put it in their terms and conditions, which are not supposed to. I think there's a lack of knowledge on what's fair, what's reasonable. And I think perhaps maybe if the SRA could give some guidance to sort of say a de minimis figure of 250 would be unreasonable, but a de minimis figure for say for £50 based on current climate would be reasonable. Not necessarily telling them what to do, but you're just giving them this would be unreasonable. If they had a lot of corporate clients, for instance, a de minimis figure of £100 might be more reasonable. But I definitely think that's a warning sign telling you from a culture perspective what their approach is. But you also, taking on Neil's point about the client interest going to help fund legal aid, I think that I know the law, Eaton-Evans Morris would be something, would be against it. And that's not because we're looking to, we don't make a huge amount of money out of client interest. But what it does do is we don't charge for, paying the estate agent's fees. We don't charge for receiving client money on account of costs. So what client interest does for us is offset the operational costs that maybe aren't, incorporated in our billable time costing, but it does help offset some of those other bank charges for just having a bank. Hope that helps, Neil.
It's quite an interesting question. I mean, there are, I think, too many for us to go through actually. Although I would say, I think it's the comment saying this doesn't sound like an SRA consultation decision made. I think that is unfair. I don't think I need Paul to say that. Would the SRA's approach to enforcement be different for a firm using a TPME if things went wrong? That's quite an interesting one, particularly given Rule 4.2 on safeguarding client money and Rule 6 of the accounts rules.
There's a ton of, we're here talking about, as you say, a proposition that will be fully consulted on, and there will be tons and tons of detail as to who the winners and losers might be or what the practical issues might be. Quite encouraged hearing from Claire that actually they might not be as significant as perhaps we might have thought. But yeah, there are a load of issues which we need to work through as we take it forward, if we take it forward. And of course, as I said, this will be a medium-term discussion, so we'll consult on this fully, and we'll need to hear from people as to what they think the practical objections might be. All I did, by way of being a protagonist, is set out strongly what the benefits were, and I think the benefits are still huge. And a number of other people on the panel have said benefits that I hadn't thought of, which I think is really good. But yeah, there will be lots of detail to work through, and I don't think it's a reputation point for the profession, and I don't think it disadvantages the profession over the accountants profession at all.
Yeah, I mean, so some of these questions are perhaps more detail than we can get into at the moment. About, there's one here about cash flow and the fact that firms can transfer funds held on account against their bills. If they can't do this, there could be serious implications for working capital models. I mean, Claire, presumably you transfer your fees as normal, don't you?
Yes. Yeah. So the fees are transferred from if they're obtained on account, from the TPMA into the office account. But to do that, the invoice has to be uploaded and the client has transparency. So there's no difference, I wouldn't suggest.
I wouldn't have thought so either. I mean, Marc, I don't know how a sense of you have on how important this client money aspect is of banks' relationships with law firms. So there's a question suggesting here that that's what the banks want. That's why they're interested in law firms rather than the actual law firm's own money, if you like. Is that a concern that banks would lose a bit of interest in the sector if they're not getting to move around clients' money and make interest of themselves?
I think, again, that's where uniformity probably helps. If there's one rule for law, it may even be advantageous in the sense that law firm independence is enhanced, right? And there is no, that sort of I pat your back, you pat mine dynamic, which can be unhelpful in a lawyer-client relationship as well. So let's not be naive about it. I think that relationship issue is there, but a uniform approach, I think, would resolve the problem on the basis of there being an alternative approach.
There seems to be a theme in quite a few of the comments about crime, fraud and crime is going to happen, whoever's holding the money. So are you, Paul, is this almost outsourcing the problem, or the regulation of the problem, or the consequences, that if it goes wrong at Shield Pay, and the fraud is there, and I'm not saying it would you shouldn't use ShieldPay specifically, a third-party managed account provider or even an escrow provider or whoever, that's their problem. It's not the SRA's. It's the FCA's problem. You can dump it on them.
Yeah, I accept that things go wrong in other sectors. I started off by saying that an awful lot of stuff goes wrong in far too many solicitors firms in terms of misuse of client money and misappropriation of client money. I think we would need to think very carefully about, as the sector develops, how we can put in place arrangements so that third-party management accounts, or indeed escrow accounts, actually are a much better option and are not at a prohibitive price. So it just strikes me there is a problem in what we're doing, exploring options to see whether or not there's a better way forward.
And it should be. And third-party managed accounts isn't the be all and end all. There are other, and with some of the things that the Bank of England's working on, the transfer of money around conveyancing transactions potentially. That is where a lot of the pinch point here is, isn't it, Paul? Really, probably conveyancing and probate are the two main areas of practice, at least.
Yeah, and I did see a comment in the chat about, I'm a conveyancer and I'm doing lots of transactions every day, and I do think those are the types of practice that we need to look at carefully in order to make sure there's a viable way forward.
Okay, we're coming up to 1:30, and I'm sure people have got other things to do. Are there any final comments that any of you like to make on the basis of what you've heard? I think we've gone through most of the questions that were for you, Claire. About actually interest that ShieldPay make. What happens to that, Claire? Yeah.
I haven't been sent any interest,
Right.
so they keep it.
Right. Okay. That's quite an interesting question that we'll have to take up offline with them. Anyone change their minds? Anyone feel a bit more any different on the issue, having discussed it?
Can I just say I still think there are huge benefits, but as contributors have already set out, there are practical difficulties that would definitely need to be overcome. So we are at the beginning of this journey. We will consult on it, but it's by no means a fait accompli, and we'll need to work our way through the practicalities to see whether it's possible. But it does seem to me that in the medium term, particularly if there is no option, then a market will develop, and I think that market could easily develop to be a safer way for clients, and that's what we're interested in.
And I think that there's one of the most recent comments is perhaps sums up the political, with a small p, difficulty that you perhaps have. Is that there's a question here: how many law firms do you think the industry will lose if you remove the possibility to earn funds on client interest? Do you anticipate mass redundancies within law firm accounts departments?
Neil, oh sorry.
Yeah.
I just wanted to give my sort of take on the sort of the final sort of summary, having listened to everybody. I don't think removing client account, I don't think that the current option is fit for purpose from a pragmatic operational perspective for various different reasons. But I think that there will be a move to remove client account. It will be inevitable. Eaton-Evans Morris are actually part of that home buying pilot that you've talked about. And we are, I think blockchain, digital signatures, electronic movement of funds will happen. I think mortgage lenders don't want to give money to law firms, and I do think something will happen. So I think that whilst TPMAs are maybe being pushed, I don't think that's a solution, but I think there will be a solution, but it's just not going to be TPMAs. And I think that the government will push efficiency in property buying. And once you start taking mortgage advances and those large values away, then I think maybe you'll see fraud not be such a big problem.
Although saying that, and I think that's a good note to finish on, that I was speaking to someone from a very large lender recently who said they're not that engaged with this issue at the moment because it's not enough of a problem for them. So change, as ever, will take its time. So that's it for this. Can I encourage you again to comment on the SRA consultation discussion paper, the link I put in the chat, and do check out Legal Futures for other webinars we put on. And thank the panel, and thank you for joining us, and have a good day.